Yo, trading family, grab a helmet. Asia just rearranged the furniture, and the United States tape has not even flinched yet. KOSPI down 5.8%, Nikkei down 3.16, Shanghai down 2.22, Hong Kong's Hang Seng up 0.16, S&P futures are flat. The Q's down 8 basis points. Did we take our dose yesterday, or is the second one queued up?
Quick reminder, none of this is financial advice, and we are two people talking markets, not telling you what to buy. Do your own research before you press the button. Tape check S&P futures are essentially flat. The Q's down 8 basis points, and volatility is not panicking. The boss is the 30-year Treasury yield at 5.33%, a 19-year high.
That yield is the spine. Asia got hit by a truck, and the United States tape has not voted yet. The first hour will tell us whether yesterday was the dose or the next one is loading. That is the checkpoint for the whole show.
The flat pre-market is the silent headline. KOSPI down 5.8, Nikkei down 3.16, Shanghai down 2.22, and the United States tape is flat. That is not resilience. That is the market saying it already repriced something yesterday. Korea first, because the intervention failed. The KOSPI dropped 5.8% in one session on August 19th, and SK Hynix fell 14% the day before, August 18th. Korean retail is the most leveraged buyer of United States tech on the planet, and they are getting forced to leveraged into the artificial intelligence trade. That is not a rerun of July. Same plumbing, new lever.
Say the difference. Cold. In July, we watched the one bleed, while KOSPI futures paused after a circuit breaker. That was quiet, structural outflow. Today, the index broke hard because the 30-year yield reached down and pulled the most rate-sensitive corner of global equities on purpose.
Exactly. July was patience, today is physics. Memory names have long-dated cash flows, heavy capex, and borrowed money in the stack. A 19-year high in the long bond hits that stack like electricity through water. The index did not malfunction. The mechanism worked as designed.
That is scarier than an accident. June 4th was a forced selling cascade, an accident in the pipe. Today, the long bond chose its target. Memory repricing is the first casualty, and it retroactively explained yesterday's tape in United States tech.
And it reframes the so-called rotation. Netflix and Apple were green, while the Qs dropped 1.7%. That was not a clean sector rotation. That was the marginal buyer of the artificial intelligence trade getting liquidated in their own time zone.
So the story chain starts there. Korea's leveraged bid breaks, memory reprices. United States tech gets the echo. The first hour will show whether we front-ran it or finished it.
That handoff is clean. Wildcard, the long bond block is yours.
The 30-year Treasury at 5.33% is the boss, a 19-year high. The July deficit was $432 billion. But the real tell is the split. Front-end yields are softening while the back end blows out. The market is saying the Fed cannot fix this fiscal premium.
Add the rate odds. Yesterday, the odds of Fed cuts were falling right next to that 19-year high. The curve is not saying the Fed is on hold. It is saying the Fed is stuck, and the fiscal premium is doing all the work. Bond traders are hedging no cuts until 27 under a curve that is blowing out.
And that hits long-duration assets first. My gut call account is long. First Solar, ticker FSLR, and it is bleeding about $3,500. Stop is set tight. That is a pure rate casualty. One concrete example of what 5.33% does to far-dated cash flows.
Right. Solar, artificial intelligence capex, anything with long-duration equity cash flows gets repriced before the rest of the tape. That is why yesterday looked defensive even before Korea had its say.
And the loop is what matters. War to oil, to the long bond to equity duration. That is the feedback system we are trading. The long bond is not one story in the rundown. It is the spine.
Hormuz next, and it is structural now. The United Arab Emirates is cutting all trade and financial transactions with Iran after 2 ballistic missiles landed on their territory. People in Dubai got missile alerts on their phones like it was a Tuesday evening.
That line hits. The middleman left the table. Dubai was the gray zone financial hub for Iran flows, and now the United Arab Emirates has stepped out. That is a structural shift, not headline risk.
Oil is at $84.74, still numb after 3.5 months of headlines. But if this catches a real bid, it refires the inflation loop and pushes the 30-year yield higher. The defense leg is its own story. Raytheon, ticker RTX, landed a $22.9 billion Tomahawk order.
I am not calling a new oil floor. The de-escalation case is real. The United States and Iran have telegraphed every step, and crude has not broken out. But if Gulf trade flows shift, insurance and shipping costs rise, and that feeds the same long bond we just covered. Keep oil as a transmission line, not a directional bet. Canada is quick. The administration paused the 50% tariff for 3 days. The United States blinked before the hit landed. That is a tariff policy tell, not a Canada trade story. Keystone is a slogan, not a thesis. One less risk-off headline into a tape that needs support.
Agreed. 3 days is a stay of execution, not a deal. Buy the rumor, respect the timeline. Earnings this week are not quiet on our authorized sheet. Today has Audi, TJX, Lowe's, Target, Veek, EL, and tomorrow has Walmart, Alibaba, DE, NTSA, Rost. So we will not manufacture coverage. The sector tape already voted. Consumer discretionary, XLY, is down 2.42% on the week.
Right. Or, the earnings calendar is not the story today. The price action in XLY is the story. We watch the tape, not a fake consensus.
The data calendar this week is where the macro plumbing gets tested. Wednesday, the United Kingdom unemployment rate, consensus 4.8%, prior 4.9. The United States Atlanta Fed GDP now, consensus 4.3, prior 4.3.
Thursday is the big one. United Kingdom Consumer Price Index, CPI, consensus 2.9%, prior 2.6. Core C, PI, consensus 2.5, prior 2.6. A hot print pushes global duration selling. A miss gives the 30-year a relief valve.
Same morning, Eurozone CPI, consensus 2.9, prior 2.8, and Eurozone Core CPI consensus 2.5, prior 2.4. European Central Bank President Lagarde speaks after that. Her tone on inflation and the long end matters.
Thursday also has United Kingdom Producer Price Index input at 6.6, prior 7.3, and output at 3.2, prior 3.5. Those are secondary, but they feed the same inflation story.
Friday, we get German producer prices, consensus 0.5%, prior negative 0.3, and United Kingdom GfK consumer confidence, consensus negative 17, prior negative 17. German producer prices are a pipeline inflation read into Europe.
The through line is still the long bond. United Kingdom and Eurozone inflation prints will move the global rate complex. If they come hot, the 30-year at 5.33 gets tested again.
Sector board shows the tape already voted risk off. The energy sector fund, the energy sector ETF, is the leader, up 4.51% on the week. Real estate, XLRE, up 1.25. Consumer staples, XLP, up 1.05.
Laggards are industrials. XLI, down 1.15. Consumer discretionary, XLY, down 2.42. Materials, XLB, down 2.74. That is defensive and energy leadership, which confirms the rate-sensitive, risk-off rotation.
Energy leading while long-duration growth lags is exactly what the 30-year at 5.33 predicts. Real estate up is a bit counterintuitive with high yields, but it may be a short covering bounce.
Watch XLY. That is the consumer verdict before discretionary earnings later this week. The tape has already voted. The numbers either confirm or deny.
International to United States, Asia was the story. KOSPI down 5.8%, Nikkei down 3.16, Shanghai down 2.22, Hong Kong's Hang Seng up 0.16. Europe is stable, DAX up 0.03, FTSE 100 down 0.07, Euro Stoxx 50 up 0.16.
The currency plumbing, dollar-yen down 0.28%, the dollar index down 0.23, euro-dollar unchanged. The yen move is modest, so the carry trade unwind risk is present but not acute right now. Korea is the main United States tech transmission.
That connects directly to memory names and the artificial intelligence complex. Korean retail was the marginal buyer of United States tech, and now they are forced sellers. That is the international story feeding United States futures.
The flat United States tape, despite Asia carnage, means the unwind is being absorbed somewhere. Either the selling pressure is done, or the next leg is waiting.
Portfolio hot news is the long bond is the boss. Drivers, the 30-year at 5.33%, a 19-year high, the front end and back end split. The Fed stuck with no fiscal answer, and war feeding oil feeding yields.
The bear case is for long-duration assets. My gut call account is holding First Solar, down about $3,500, stop at 210.42. Memory and far-dated artificial intelligence CapEx are the same trade. The bull case is the hedges. Apple, ticker A PL, is working as a hedge, up 1.2% on a day the Q's dropped 1.7, stop at 295.
My wave trader algo is flat, but my paper account is long, that Apple hedge. That is a rare disagreement between the two. On a day growth sold off, Apple held green. The book is working.
My TFT algo is flat too, and my gut call account is all cash except the First Solar position. $9,966 in cash, 0 new open. The energy sector, ETF, is tempting, but I've churned that trade 3 times and gone flat every time. No trigger, no alert into tomorrow's inflation gauntlet.
The second order effect is the loop. War leads to oil, leads to the long bond. The long bond leads to equity duration sell-off. First Solar and memory are the same trade on different tickers. Apple is the hedge that pays if the market hides in cash-rich megacaps.
And the discipline is not pressing into a heavy calendar. The setup comes to us. We do not chase it into United Kingdom and Eurozone inflation prints that could reset the whole curve.
If those prints come hot, the long end has room to run and long-duration assets bleed. If they come soft, that is the relief valve and we squeeze. The reaction is the trade.
Exactly. My gut stays on a leash. Being right today means knowing when not to press. No new positions until the bond tells us the direction.
What we are watching tomorrow, United Kingdom CPI, consensus 2.9, prior 2.6, and Eurozone CPI, consensus 2.9, prior 2.8. Any hot print tests the 30-year yield again.
We are watching the 30-year at 5.33%. A break above that recent high signals more duration pain. Below it, the relief trade resumes. We are also watching KOSPI and Nikkei follow through, because tonight's Asia session tells us if forced selling is done.
And oil at $84.74. If it catches a bid, the inflation loop refires. If it fades, de-escalation remains the baseline.
That is the watch list. Keep stops tight, keep heads clear, and let the tape show its hand before you press. We will see you at the open.